change one thing that changes everything. It'll set you on a new financial path forward. To make that one change, though, you got to change your mindset a little bit. Every single dollar that I put into all of my whole life insurance policies, it will never stop growing, even when I'm using the money for other things. Having that high interest debt, having any debt hanging over your head where your money's going to somebody else's bank through all that debt, instead of into your own family's financial lives and preserving that money for the future, I would say right now is probably one of the most important times of your lifetime to do everything you can right now to get out of debt. All right, what's up, everyone? Welcome to Wealth Webinar Wednesday. I'm Stephen Nagy. I'll be hosting today on behalf of Chris Naugle. Welcome if you're new here, and thank you for being here. If you've been around our campfires, we do this Wealth Webinar every single Wednesday, 1 p.m. Eastern. We've launched this thing back in like beginning of 2020 as a way to be able to start sharing these powerful strategies, how to become your own banker, but more importantly, how to take back control of your money and solve your money problems. So what we're going to do today is I'm joined with my co-host, Craig Yenny. What's up, Craig?
Hey, Stephen, glad to be here, and all's looking good on your side as far as the whiteboard, so let's do it.
All right, awesome, man. Well, thanks for being here. So Craig is our in-house genius when it comes to taking the crazy concepts that Chris and I are always talking about. Craig takes all that and turns it into beautiful visuals and charts and spreadsheets and really brings our theory to reality. And it's really neat to see. So we're going to talk a little bit today to start this webinar off on if you're new here, like how, what this looks like, how we can start helping you, if this is right for you. Just a quick little disclaimer, we don't have anything to sell you. Wealth Webinar is all about education value. So this is not a sales pitch. I'm not going to try and sell you anything. If any of this makes sense, all we'll do is ask you to schedule a call with one of our certified money mentors, and they'll talk to you about your situation and see if there's anything we can do to help you. But again, there's no sale even involved on that phone call. And as Chris likes to say, if somebody is trying to sell you on that phone call, let us know and we will beat up that money mentor, because that's not what we're all about. We're all about value, providing education, and helping you solve your money problem, regardless of what that looks like. So let's go and talk about this for just a few minutes. And I have this whiteboard back here. I don't get to draw too often, so we're gonna have some fun with this stuff. And I'd like to get some participation by the crowd as well. First off, when we talk about BYOB, what does BYOB mean to you? I'm just curious. Put it in your own words over in the chat box, what BYOB means to you, all right? All right, so BYOB, technically be your own banker, becoming your own banker, be your own bank. You guys get that? So, and I'm asking in your own words, so let me see what we got here.
Bring your own bandages.
Your own bandages, yeah, that's no dependent.
Ooh,
not
be your own boss.
Okay. Shauna said choice. I like that. Hands up, first time attending. Welcome. David in
A
the
bunch of comments on freedom, control.
Freedom. Pay interest to yourself. Okay, I love it. All right. So there's lots of different ways to be your own bank. And we're going to talk about that today, because a lot of what we do, and by the way, nothing that we do is new. Okay, what we teach, what we do with becoming your own banker, these strategies have been around for over a couple hundred years now. They're used by some of the most successful and wealthy families in the world. They're used by business owners. These strategies are used by banks themselves. So all we're doing is taking something that's been around for a long time and bringing it to you in a nice little bite-sized package that anybody can understand, and anybody, no matter where you're starting right now today, can take advantage of. And that's it. So that's the bottom line. All right. And becoming your own banker at the end of the day is really about controlling your money, controlling the way your wealth flows, the way your wealth grows, controlling the interest that you bleed out in your life, controlling the wealth killers that most people aren't even aware of, things like inflation. Becoming your own bank can completely eliminate the worry for inflation. Why? Because your money's always moving, making more money, outpacing inflation. So we don't have to worry about our money losing to inflation. Just an example, taxes. Taxes is a big thing. We can teach you strategies today that are going to save you a lot in taxes. In fact, when we get to the second half of this, and Craig brings up the beautiful PowerPoint he's created to show you how to use this in retirement, where a lot of people get worried about taxes, get worried about, building up for retirement because taxes do erode so much wealth. Market risk. the ups and downs of the markets. Let me ask this. Does anybody have money in the stock market right now? And or another way to ask this maybe is, does anybody have a 401k? Does anyone have an IRA? Well, 98%, 97, 98% of all IRAs and 401ks out there are made up of the stock market. So even if you don't directly own stocks in a brokerage company, something like that, odds are you do own stocks in one of these retirement accounts that almost all Americans have. All right. So where is the stock market right now? Is the stock market down right now, or is the stock market up high right now? It's up high right now, right? We're breaking all-time highs almost every week. And so we want to start looking at what other people are doing. So would you all agree that Warren Buffett is a pretty smart investor, pretty smart business guy? Greatest investor minds. And
Knows when
Warren
to hold them
Buffett's
and fold them.
strategies, yeah, Warren Buffett's strategies are very, very simple. Warren Buffett has some kind of staple sayings. One of those is buy low, sell high, and don't lose money. Sounds simple, right? Warren Buffett goes and he looks at the technicals, the fundamentals of companies, and he invests that way. Well, what is Warren Buffett doing right now? Is Warren Buffett in the stock market? What do you guys think? No. Warren Buffett's selling right now. Warren Buffett is sitting on something like, I don't know, Craig, maybe you can pull this up. How many billions of dollars is Warren Buffett sitting on in cash right now? Warren Buffett's been selling over the last couple of years. He's stockpiling cash. Why? Because he knows something's coming. And that something might be perseverance of wealth for him, or in my opinion, he's getting ready for opportunities. Because when there's blood in the streets, that's when you can go out there and really take advantage. And there's a couple things.
Can I ask you something real quick, Stephen, about him? Just something that might not be so obvious is when you say Warren Buffett's not in the stock market anymore, that doesn't mean that he realized his gains or sold, right? Does that mean he just went to cash and he's just on the side to buy back?
Sure. So Warren Buffett's in the stock market. Warren Buffett's in stocks. You know, he doesn't sold everything. He just slowly selling off his portfolio of stocks that he thinks are super overvalued. Like he just sold a bunch, I believe it was Apple like a month ago, something like that. But yes, Shawnee, he's selling off those stocks. So when you buy a stock, you're trading cash for a stock. Now you own that stock. Now, why do people do that? Well, cash does what? With inflation, cash over time devalues. So that's why if we think back to when we were kids, how much cheaper was everything? How much was a gallon of gasoline? How much was a loaf of bread? How much was a gallon of milk? How much were eggs? How much were clothes? How much was it to travel? How much were vehicles? How much was everything in our life? Okay, so what a dollar back then purchased you, a dollar today purchases you a lot less. It takes a lot more dollars to buy that exact same thing. So over time, because of inflation, our dollars get devalued. So one of the goals with building wealth and becoming financially successful is being able to make those dollars keep up with inflation. Remember before I said the 3 wealth killers? So let me just bring it back to that for 1 second. So the 3 wealth killers, number 1, because this is going to be a basis of what we need to start looking at. And guys, the reason I'm starting with this right now is because everyone listening here needs to have a strategy, a financial strategy. And you might not be ready for your own financial strategy yet, but we're going to talk with you about this. And it can be as simple as making one change where your money goes first. Make that one change and then start learning and snowballing it from there. So we'll talk about that one change and how anybody on here can do that. But these 3 wealth killers, very simple: inflation. And if we can eliminate these 3 wealth killers from our life, it's going to put us on that much better of a path moving forward. Number 1, inflation. Number 2, taxes. And number 3, volatility. Okay. So I was just talking about inflation. All right. So how do we eliminate inflation? Well, that's what I was mentioning about trading dollars for stocks. So people, what they'll do is instead of having their dollars and just holding on to dollars, putting them under their mattress, you know, burying them in the backyard, wherever, where that dollar is going to devalue because of inflation. Well, what do people do? They use those dollars to buy things, to invest. And that's basically all an investment is for, is to have your dollars growing for you over time, as opposed to shrinking over time. Does that make sense? So we want to eliminate inflation from our lives. So we can do that by investing in stuff. Now, historically speaking, if you look at the stock market over time has always done what? It's always gone up. If you look at any 10-year time span of the history of this country, the market's always going to start to go back up. Now, along that path of going up, what does the market do? Ups and downs. 1929, Great Recession, was a huge drop. The 1960s, another big drop. 1999 going into 2000 dot-com bubble, big drop. 2008, great recession, huge drop in the markets. We were getting into 2019 and into 2020, there was getting ready to be another huge drop. But what happened instead? COVID happened. It was an instant drop with an instant hockey stick back up. Now, when COVID happened, that is a difference. There's a big difference there in the markets, because the markets are going to do their thing. But what happened with inflation when COVID hit is the country, the world shut down, and then the Federal Reserve pumped trillions of dollars in the markets. They printed all this money and they kept things artificially inflated, which caused all the inflation we saw over the last 4 or 5 years. But nonetheless, the markets have really skyrocketed since 2020, when in reality, they should have dropped at that time. So right now we're in a really overinflated market, a really overinflated bubble. And it's what a lot of economists say. Remember, we read a lot of these white papers and study what these economists say, so you don't have to, so we can just teach you this stuff. All right, so when it comes to these markets, they're always going to go up and down, up and down, up and down. Now, if you're 20 years old and you're looking at retirement when you're 60, that's a 40-year time span. So if the markets are at all-time highs right now, and your dollar cost averaging in, you're buying stocks regularly, and the markets come down over the next year, are you worried about it? Maybe not. Maybe you're just buying all the way down. You're never going to time the markets. And why do you not worry about it? Because over time, the markets are going to do what? The markets are always going to go back up. At least they always have, historically speaking. And that's kind of like the common traditional way of looking at the stock market. I was a licensed financial planner right out of college. So Series 7, Series 66, I worked with Ameriprise Financial Advisors. And, this is the stuff we were taught, to sit down and show people how to invest wisely within their 401ks and put some extra money aside into brokerage accounts and let us manage that money in the markets, which, by the way, indexes outperform almost all stockbrokers out there. So stockbrokers, stock pickers aren't really doing what they say. They're a whole different story. But the bottom line with inflation, that's all we're trying to do, is we're trying to be smart with what we're buying. Now, I've become a big fan of real estate over the years. Exact same thing. Why do we buy real estate? Well, real estate, we can buy a house down here. What happens with home values over time? Well, when my parents were young, you could buy a home for $20,000 or $30,000. When I was a kid, you could buy a home for $100,000. When I was at my age where I could start buying homes, there were a couple $100,000. Well, now the median home price in this house is like 400 grand. So real estate also goes up. Now, real estate can do some other things. Of course, you can force appreciation into real estate by buying a property, fixing it up, and forcing the value up. You can buy real estate and you can rent that property out, for example, and create cash flow, regular income cash flow, while that property is appreciating. There's lots of tax benefits for investing in real estate. So there's a lot of advantages, but also it becomes with a little more active. Remember, a stock. What is a stock? If this is a stock and I buy that stock, do I have any control over the value of that stock? If I buy Tesla today, do I have any control over what happens with the value of that stock? No. Elon Musk, the CEO of the company, could go on a podcast, smoke weed, and all of a sudden the stock dropped like a rock. And that happened a couple of years ago, if you guys remember. So we have no control over that. Okay, so there's different, so it just depends on what you're into. But again, the reason why people buy stocks is because most people buy a bunch of stocks. Okay, so stock A, stock B, stock C, stock D, a bunch of stocks. And this is what is considered like a mutual fund. There's index funds, and basically that's just a basket of stocks. And the idea is if one of those stocks drops, well, the rest of those stocks are going to keep the value of your overall fund up. And that's fine. That's what most people invest in when it comes to 401ks and IRAs. That's what most advisor groups do and things of that nature. But again, we're back to where we are today. So we're taking our dollars, we're trying to put them into smart investments so that money will grow instead of shrinking through inflation. Does that make sense, Shauna? I know that was a lot right there, but I just wanted to give a bunch of examples to kind of set the stage. We following?
Yeah.
All right. All right. You guys heard my dog piping in earlier, so she was listening. All right. All right. So we got inflation. So that's what we want to do with inflation. We need to keep that going. All right, so we want to be trading those dollars. All right, now taxes. I mentioned taxes a couple times. So taxes can erode wealth. I mean, everybody's familiar with taxes. Nobody loves paying taxes, especially everything we've witnessed over the last couple of weeks with where our tax dollars go. I don't know about you guys, but that makes me want to pay less in taxes, not more in taxes. Now, fundamentally speaking, Are taxes a good thing? Yes. They provide civilization, essentially. They provide all the beautiful things that we have in life that we all take advantage of as being part of society. So taxes are very important, don't get me wrong. But like I said, as we've seen the last couple of weeks, we've seen a lot of waste in taxes. So this is the way I've looked at this for the last 15 years of my life. Let me pay my fair share in taxes. What does the fair share in taxes mean? Okay. Well, we take a tax code book. That's very, very, very good. Tax code. Guy on here, Jimmy, right now, that could tell you almost every line of this code book because the guy's a genius with taxes. Me, I just know to listen to people like Jimmy and take advantage of this stuff. So why is the tax code book like this big, written in little 3-point font? Because there's tons of little technicalities in there that are 100% legal that most people just don't know how to take advantage of. Okay. But this is all legal stuff that every single one of you can be taking advantage of. So what are we going to do? We're going to pay what we're required to pay in taxes while working with somebody smart enough to save us as much as we can in our own pockets. Because if I make $100,000, just hypothetical numbers here, if I make $100,000, let's say 30,000 of that is supposed to go to taxes. Okay. But I can work the system legally and I can pay instead $10,000 to taxes. With all the government waste and everything that we have going on right now today, are you okay with that? I'm still paying in, but I'm keeping some, right? Now, what do you think I'm going to do with that $20,000 in savings? Instead of giving it to the government, what would you do? And I'll tell you what I do. So instead of paying 30,000 to the government in taxes, you're only paying 10. What are you going to do with that extra 20? And this, there's no right or wrong answer here. I'm just curious what people would do. $1,000. Because in my opinion, it depends on where you are in life. So if you're barely getting by and you're on this journey of learning financial education, learning how to take back control of your money, and you have a family and you're barely getting by, remember, the government causes a lot of this inflation. The Federal Reserve causes a lot of this inflation. It's not our fault that it happens. It's not our fault that our money gets eroded, that we can't buy as much today as we could 10 years ago. All right. So in that case, I'm perfectly good with you taking that extra $20,000 and investing it, growing your wealth. Because what happens when you invest it? You're putting it back into the economy. You know, if I go and Craig is like, you know, I'm doing a real estate deal right now, Steven. I'm gonna buy this house. I'm gonna fix it up. I'm gonna rent it out to a family. He's like, listen, for me to do this deal, I need $100,000 from you. I'm going to say, awesome, Craig, let me give you that $100,000 to do that. Craig's going to pay me interest on that money. So I get my money growing for me. But then what's Craig going to do with that 100 grand? He's going to make a beautiful home and he's going to rent it to a family. He's improving the community. He's improving humanity, so to say. Is there anything wrong with that? No, it's perfectly good. And in the meantime, is Craig going to make money on that deal? Absolutely. So now I'm making money. Craig's making money. A family out there has a new home. And what happened in between when he was fixing that thing up? Well, Craig employed a roofing contractor. Craig employed a paint contractor, a landscape contractor. Craig's out there pumping money into that local economy by doing this real estate investment deal. So by me saving money in taxes, I can take that money and start putting it into things like that. Maybe I start a business. Maybe I just put it back into the stock market. Whatever, you know, I'm doing something to improve my family's financial situation. Now, once you get to the point where myself, Chris, Sean, and Craig are at, and I'm not going to speak on you guys' behalf, but I'm pretty sure you guys are doing this also. What I do now is when I have money that I save in taxes, I say, okay, I'm doing pretty good financially. So what can I do to improve this world? So I'll take this money and I'll donate it. I'll take some of it and I'll start donating it to charities, to causes, to foundations that I know they're not going to waste it all. They're not going to waste all that money. They're going to actually use that money for good causes. Is everybody okay with that? And the reason I'm making some of these examples is because a lot of what we do as business owners, as investors, as real estate investors, is we take advantage of situations. So I mentioned before, when there's blood on the streets, you can make tons of money. When a market crashes, you can make tons of money. There's always money to be made in real estate investing. There's always money to be made in the stock market. But when do you make the most money? Times of volatility. When the stock market crashes, I'm making money all the way down buying puts. When that market's down, I'm buying stocks and riding that appreciation back up. When the real estate market crashes, what do I do? I'm going out there, I'm getting foreclosures. I'm buying homes at heavily discounted properties. Why am I doing this? Because buy low, sell high, and don't lose money, just like Warren Buffett said. The problem is a lot of people will buy high, hold it till it goes down, panic sell out of fear, and lose money. That's what most people do. So we just want to kind of change our mindset. And as we start talking about becoming your own banker, the infinite banking concept, what we teach and do every single day, it's just a shift in your mindset. Remember I said you change one thing that changes everything. It'll set you on a new financial path forward. Change one thing, and that's literally it. And we got to make that one change, so you got to change your mindset a little bit. And that's what we're going to focus on during this webinar today, all right? So that's what I'm talking about, is taking advantage of situations, never taking advantage of people. Never, 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 never. And I can't make that clear enough, because there's wealthy people often get a bad rap. Investors oftentimes get a bad rap. And some of that's warranted, because there is shitty people out there. I don't know how else to say it. There's bad people out there in this world that do take advantage of people. That's not what group is about. That's not what the BYOB Money School, Money Multiplier. And Shauna, if you were at the office, I'd have you put up the core values. Our core values are big on the wall in the BYOB office. And it's all about, we do the right thing for the client every single time. None of it is about us as agents, as business owners. We do what's right for the client. We give our best stuff away for free, because we know if we can help enough people, that we'll get the returns in the long run. And that's exactly, probably, if you guys have been following us since 2020, 2019, that's what you've seen us do and seen happen. So again, thank you all for being here today. We appreciate you guys hopping on this thing every week. If you're new here, thanks for taking 90 minutes, 60, 90 minutes out of your day today to be here. And hopefully some of this stuff starts to resonate with you guys, because it's so easy. It's just different. It's something you've maybe never been taught before. And so once you start doing it, though, here's the cool thing, is it becomes like second nature. It's like, oh my God, you can never go back to doing it the old way. You know, when we teach the infinite banking concept, we have what we call the 90-minute presentation. And at the beginning of that 90-minute presentation, it's all about mindset. And there's a video that we always recommend people watch. It's called the backwards bicycle. So if you go on YouTube after this webinar, type in the backwards bicycle, watch this video. And it's a great analogy about what we do, because what it does is it takes somebody that's riding a bicycle. All of you on here know how to ride a bicycle, right? So it takes somebody that's riding a bicycle, they hop on, you can get off of a bike and jump back on it 20 years later. Guess what? You remember how to ride that bicycle. It's one of those things that's like ingrained into your mind. Well, that's what happens with traditional finances, with money, with investing in this country. We get ingrained, invest in the 401k, dollar cost average, hire a financial advisor, do all these traditional things. But does that work? For most people, it does not. Most people in this country are retiring, struggling, having to go back to work, trying to live off Social Security, which is a whole disaster area right now, and all this other stuff. So we want to make that one change. So the backwards bicycle in this video, what they do is they just change one thing, the way the handlebars operate. So instead of when you're riding a bike and you go to turn the handlebars one way and you turn, well, they make it opposite. So when you go to do that, the bike goes the other way, and guess what happens? Nobody can ride that bicycle. Well, we hear that all the time when people start with us becoming their own bank. They're like, I get it. I think I can do this. Let me jump on this bicycle. And then what happens? They fall over. And they're like, oh man, but then they get back up and they do it again. And then after you're up there and you have somebody helping you, maybe get somebody to hold the bike, and they start showing you to hold it. And then what happens after time and time and time again? Guess what happens? All of a sudden now you're able to ride that backward bicycle. And I'm not a scientist, guys. I'm a money person and a business person. And so I'll let the backwards bicycle video go into like the psychologics of it and the mind and how your mind operates. It's really fascinating video. So definitely check it out. But all I know is that's exactly what we've done with our business, is we teach this stuff. We have 6 live webinars every single week that you can come on, you can interact with us, you can ask questions, you can learn. It's brand new content every week. We put out new videos on YouTube almost every single day. Pure education. This is all free training and free education, because we know if we can hammer this into you enough, you're eventually going to have that mindset shift. And not only that, but if you do fall off that bicycle, where are we for you? Those of you that have policies with us, that have banking systems with us, what do we have? We have our implementation team. We have our money mentors. We have our entire organization that's right there to help you when you fall down, to bandage you up, to get you right back on that path. Because what's the other thing that can happen with a financial strategy or with goals? Can they change? Absolutely. There's unforeseen things that happen in life. There's natural disasters. There's jobs that go away without us expecting it. There's, divorces and deaths and diseases that, like, life is tough enough. And so what we do is we said, okay, it's the same with financials. Like, you might be on a good path to paying off debt. God forbid something happens, all of a sudden your path to paying that debt off, all of a sudden you're back to where you started. But guess what? We're right there holding your hand, recreating that plan with you to make sure to get you back on that path. And that's what we found takes success, is education, training, support, and having that helping hand right there for you. So that's what we're all about, guys, just in case anybody wanted to know. And we're going to do that with all this stuff. And then, of course, my third wealth killer, just to hit and finalize the third one right here, my three wealth killers, volatility. And that's what we were talking about with the markets up and down, not riding that. So what we are starting to look at, what we've been talking about now for this last year, definitely going into the rest of 2025, is we're a little less concerned right now about growth, and we're a little more concerned right now with preserving our wealth. Okay? Or if you are not quite in the wealth growth mode yet, maybe you have a bunch of debts. You're like, hey, I'm just trying to get out of this rat race, get these debts paid down, get myself out of the paycheck to paycheck lifestyle. That's just as important, because I'll be willing to say this, Craig. My opinion, I think this is probably the most important time in my lifetime that somebody should be debt free. I don't see rates coming back down anytime soon. I see some tough financial times ahead. And when that happens, having that high interest debt, having any debt hanging over your head where your money's going to somebody else's bank through all that debt, instead of into your own family's financial lives and preserving that money for the future, I would say right now is probably one of the most important times of your lifetime to do everything you can right now to get out of debt, at least bad debt, okay? Now, I am a student of Robert Kiyosaki, Rich Dad, Poor Dad, so I do agree with things that there is good debt versus bad debt, and I think that leveraging and taking advantage of good debt is very important, especially if you need to, like, get really get somewhere quicker, like build your wealth quicker for whatever reason. And I would say right now, if you have debts, focus on that first and foremost. And Craig, maybe I know we're going to talk more about and I think we're going to talk about that when we get to your slides, right?
Absolutely. Yep. We'll talk more about that.
Okay, cool. Did you want to add anything to just any of that real fast while I'm deleting this?
Yeah, I think that's spot on. Those are the three wealth killers. And now let's talk a little bit about, what do you do in opposition to that?
Yeah, absolutely.
And do you mind if I ask something in the chat real quick too? Because we did get so many new people in here, and I put in the chat that we stick with us. We've been doing this for probably 6 years every Wednesday. I don't think we've missed a Wednesday except for this year in 2024. Christmas was on a Wednesday, and New Year's Eve or New Year's Day was on Wednesday, so we did miss those ones. But otherwise, we've been here. If this is your first time, what are your goals right now? And then I want to see like the newbies talk put that in the chat. And then after we get some of those answers, the people who've been here for years, if you don't mind sharing what your goal might have been when you first joined the Wealth Wednesday webinar to what your goals are now, because I journal a lot, and I look at my goals that I've set for the years, and my mind used to dream so much smaller where I was 5 or 6 years ago. And because of this community and because of just repeatedly coming back to the Wealth Wednesday webinar, the goals I have, I can't even believe that I have them at this point in time. So yeah, I'm just trying to speak life into y'all, but that's kind of what I'd like to see as we transition into this next piece. Thanks.
Yeah, please add that in the chat box. We'd love to see that, and we can make a note of some of that stuff. We can add it into your file as clients. So when we chat with you, we kind of have a head start on what you're looking to accomplish. And I love that, Shauna. Thanks for saying that. All right. So when we start looking at, okay, so how do we start transitioning to make that one change? We want to kind of start thinking about, where is our money? Okay, where do we warehouse our money? How does it flow through our lives? And what does that look like to make that change? So for most people have a savings account. And then that savings account is usually located where? In a bank, right? Most people earn a paycheck. And then when that paycheck comes in, what happens?
It goes away.
Goes to pay bills. It goes
Does.
to
So the
pay
income,
credit
hey,
cards,
paycheck comes to bills. What do you say? Credit cards?
car loans.
Yep. So all that kind of stuff, loans, goes to all of that. You know, income might go to life. So life, I mean, do any of you have children? I don't know about you guys, but my son is 9 years old and he's kind of expensive. So, you know, quite a bit of this goes to that, right? Travel, vacations, food. Did you know that strawberries, a little thing of strawberries, are like $9 a carton right now?
Yes, my daughter's so picky, and she loves strawberries, and they are very expensive.
Son eats a half a container every single morning, and they're $9 a pop now. It's just insane. He's going through 18 eggs a week right now, too, and a gallon of milk a week. So, anyways, so life, everybody knows life. Everybody's got their own life. So for most people, at the end of the day, and on average through the last like 25 years, about 90, about 90% of income goes to these two things first. All right. In reality, today, it's closer to like 98%. I believe the savings rate right now is approaching zero again, which is not good because the flip side of that is not only is the savings rate going to almost zero right now, but credit card balances and credit card debt in this country is actually at all-time highs. It just hit over $1 trillion, I believe. So it's kind of going the wrong direction. But this is what most people do. Again, and a lot of the cause of this is because of inflation, because of taxes, because of volatility. All right. So what this leaves for most people is 2 to 10% of that paycheck then goes where? Over to savings. All right. Or maybe some of it goes into investments, which most people don't even have money to invest right now. All right. But for people in general, though, they have their savings, they have their income, and then they do have investments. So investments could be 401k, could be IRA. These two types of investments are what are called qualified funds. Okay, keep that in mind. Qualified funds. And all the qualified funds, IRAs, 401ks, all that means is there's a tax code that says if you take your money and you put it towards retirement, you can either grow that money tax deferred, where you get a tax break today and then pay tax a little later, or you can grow that money in what's called a Roth IRA or a Roth 401k in a tax-free manner, where you pay taxes today, the money goes in the Roth, and then it grows tax-free in investments, until you pull it out. So those are, and then you also have non-qualified investments, which is basically just like investing your savings or investing cash, where all your typical either capital gains or the type of investing that you're doing, it'll be taxed that way. Okay. So there's advantages, there's way to save on taxes with these things. But the reason I'm mentioning this, because it's come back in a minute on what we're going to be doing with our money. All right. So this is what most people now. Does anybody have money anywhere else? One of these things. And again, investments could be almost anything. It could be precious metals, gold and silver. It could be real estate. It could be stocks, crypto. Yeah, crypto, exactly. But is there anything else I missed? Even business, if you're putting your money into a business, I would typically consider that an investment. Real estate's typically an investment.
I do want to run something by you both, Craig and Steven, is when I asked those goals, a lot of people, and I had this goal too, which was to replace your income, because working actively, especially if all of your paycheck is going away, it's very disheartening. It feels like I'm sick of this. I'm a slave to this. I want to get out of this. And so your goal at that time is sometimes just to replace it. But I've found that over the years of unlocking what to do with money, I do want to work actively and I want to build passively. So instead of just replacing my money, I kind of want to grow it. So I do also think what Steven you brought up in the beginning about what's coming and what's ahead is I want you guys to not dream so pie in the sky that you're going to replace your income, but that you want to build your income and know what to do with it better. I don't know that we're necessarily in an environment to not have to work actively.
Yeah, I can hit that. I'll come back to that in a second, Sean. That's a
Okay.
great. No, that's a great comment though, and something that a lot of people do have on their minds. Like, well, let's just say retirement. If I know I need, X amount of dollars in retirement, well, what do I need to do to be able to produce that income, to be able to produce that cash flow, to be able to live that lifestyle? Or, maybe you're, going to turn 40 years old in a few years and you're like, I'd like to cut back on as much, work so I can continue to work and build wealth, but I also want to have that passive income coming in, or that cash flow coming in where I can take more time off and travel, spend with my daughter or whatever the case might be, right?
Yeah.
All right. All right, cool. So what we want to do, so this one change, just to give a quick example of this. So becoming your own bank, the foundation of becoming your own bank, when it comes to non-qualified money. So here we're talking about non-qualified, so not 401ks or IRAs, any of that, the non-qualified money. So basically all this income, all your savings, everything else. The foundation of what we have, okay, I'll just draw that down here. The foundation of this is the BYOB. So instead of Wells Fargo, we now have our own banking system. And the way we do this is with a specially designed and engineered whole life insurance policy. Okay, now the reason we use a specially designed whole life insurance policy is because it's the only vehicle that the United States of America legally allows us to use to be able to do everything I'm getting ready to show you guys. Okay, if there was something else that does everything that a whole life insurance policy does for us, we would use that instead. But because it's a whole life insurance, because the United States government tells us this is how whole life policies operate, we just take advantage of this. Now, again, this has been around for over 200 years, even when they changed the tax code, even when everything's happened with the IRS and the Federal Reserve over the last 100 years and everything else. This has remained the one and only financial vehicle that allows us to become our own bank the way that this does. Okay. So before I erase this stuff and show you guys everything this is going to do for you, let me just show you the one change. Okay. So the one change, as I mentioned before, 99% of people live this way. Their paycheck goes to bills. Their paycheck goes to life. Whatever's left over goes to savings and investments. So we're going to change one thing. We're going to change that our paycheck first goes over into our savings. Now, we're going to eliminate this big savings account at somebody else's bank. And we're going to now create an account at our own banking system with this specially designed and engineered whole life policy. So one change, instead of paying everyone else first and the remainder going to us, we're going to pay ourselves first. That's it. From there, we're going to funnel the money over to here. We're going to funnel the money over to here. We're going to funnel, what I say before, we're going to do as much as we can to funnel this money through here to pay off these debts. And we'll show you this stuff exactly how this works in a minute when Craig pulls up his slides. But I'm showing you the one change. So instead of it going to everyone else and the remainder, now we're going to pay ourselves first and then cycle that money like that. Okay, now that might sound crazy because you've never done it before, you've never heard of that before, but this is the essential basic of what we're going to do with this. Is that fair enough to say, Craig?
It is, and I was on mute, but absolutely, I'm going to go over a use case showing that exact situation. And I like what the conversation is in the chat because people are talking about the process of putting your money to work. So we're going to put our money to work and getting rid of those debts first. And then when those debts are gone, we're going to capitalize and have more money that we can put towards building that income replacement or that, freedom that everyone's looking for.
Absolutely. Okay. So one more thing, Craig, before we get to your slides.
All right.
And I'm going to share this because I want everyone on here thinking, again, what is my strategy and what does this look like moving forward? Now, we're going to walk you through that again on a strategy call. We'll spend an hour with you on a Zoom one-on-one talking about your situation. But I need you to come to that call prepared. So I want you to start thinking to yourself, where is my money and what sources of money do I have? Okay. So where is my money? All right. Is it debt? So where is my money? Where's my money? So is there debt? Is there debt? Where is my money? Savings. Where is my money? Stocks, real estate.
Equity.
Where else could money be? IRAs, retirement, right? Anywhere else?
Yeah, we could put equity in there, but that's part of real estate. But I think equity could
like your
apply.
primary. Yeah.
Yep.
Okay, so here's what I want you to start thinking to yourselves. If you have debt, I want you to list this debt out. Amount, interest rate, amount being balance, and then minimum payment. Anything else, Craig?
Yeah, and it's also good to know what they're actually paying because some folks, we run into some situations where maybe there's a credit card balance and someone's putting $1,000 a month into it, but the minimum's 200. Well, there's an opportunity to do something different with that difference and still pay the debts off.
Perfect.
Mhm.
All right. So if you have any debt, what is it? Balance, interest rate, minimum payment. What are you paying now? Bring that to your strategy call. Okay. What we're going to do is we're going to start talking to you about that income, where that's money going now, what your income is, what savings you have. We're going to take all of that information and we're going to design one of those specially designed and engineered whole life insurance policies I just mentioned. Now, remember, there's no commitment on your part to learn any of this, for us to create this plan for you. We're not charging you for this. This is a completely complimentary service. We are so confident that we know that if we can get you on a call and lay this out for you in a very logical manner for you and you understand it, there's no way you won't do it. So we'll do all this stuff up front for you. Never charge you a dime. We know because we know it'll benefit you and your family for the rest of your life. And you'll never go back to the old way of doing it. So we're willing to do that for you guys. So we'll do all this for you. So I want you to think about that. Now, if you don't have a lot of debts, you're like, I could just, or let's say you have, just let me give an example. Let's say you have 50K in debt. And they just heard me say 50K in debt. And they just heard me say, debt, you got to eliminate debt right now. It's so important. And maybe they have in savings 50K in savings. So right now they're getting ready to leave this webinar. They're like, oh, well, I got to get rid of this debt. Let me just go take my savings and I'll wipe out the debt. Is that a good move or a bad move, Craig?
I would say it's a bad move because we can capture that 50.
Okay, let me explain what Craig means by that. So if I was to go to my bank right now at Wells Fargo, let's use an example, take $50,000 out and pay off that debt, what happens? Well, that $50,000 in debt is gone, but what also happens? That $50,000 in savings is also gone. So I'm
Yeah,
kind of
that opportunity cost. It's the opportunity cost. We can no longer ever make money with that money again. It's gone.
that 50,000 is now gone.
Yep.
So here's one fundamental difference in a Wells Fargo bank versus our own banking system using this whole life policy is that $50,000 in my BYOB bank. Now, remember, we changed the one thing. Instead of the savings going to Wells Fargo, the savings now goes to our bank. So that $50,000 is in our savings, but it's in here now. Okay. Now we take that same $50,000 from our policy and we use that to pay off the debt. Well, as soon as that happens, what happens to this $50,000? Nothing. That $50,000 is still there. And I don't want to get too technical with things right now, but the way a whole life insurance policy operates is when we design one of these for you up front, and I know a lot of you are thinking, well, I don't have $50,000 or, I only have 5 or 10 or whatever the case. I don't have any savings right now. That doesn't matter. That's irrelevant. We'll design and build this thing that meets your financial situation. I'm just giving an example here. But what we can do is we can build this thing where $50,000 goes in it up front. And then maybe you're saving a much smaller amount in the future because maybe it took you 10 years to save that 50,000. You can only save 5,000 a year. Great. We'll dump the 50,000 in so you can pay out that debt. And then we'll start putting 5,000 years back into this thing in future years. Fine. We can do all kinds of stuff with this is the point. But what we're doing in this case is when you now use the money in your banking system, in your whole life policy to do something like pay off debt, here's the beauty of it. You're not actually taking your money out of that policy. You actually borrow against the insurance company's general account using your policy as collateral. And what that allows us to do, and this is why we use whole life. Again, this is the only financial vehicle in the country that allows us to do this. So by taking this loan from the policy, from the insurance company, what that allows is our money to sit in our policy and never leave. Now, here's the best part about all of this I didn't even mention yet. When we put our money at Wells Fargo or something like that, what is the savings account rate right now at a traditional bank, Craig? Like maybe 2%, 3%? Not a high yield savings, but just a traditional
Yeah,
savings.
we've run some numbers, and I think over the past 10 plus years, it's like 0.6, 0.7. It's not huge, but there's definitely going to be some exceptions. People can still find some high yield savings accounts, but over a long period of time, it's been pretty low in terms of savings account rates.
And the rate, the interest rate, the dividend rate of which the money in our policies grows over the last, let's say 20 years? What's the average there? About 5%?
Yeah, I mean, you could do 5 would probably be a safe number.
Yeah. So over here, our money goes into somebody else's savings account, growing at 0.6, 0.7%. We use it to pay off debt. It's gone forever. We made one change. Instead of going to somebody else's bank, the money goes into our bank. Once the money's in that policy, it never leaves there for the rest of our lives. Until the day I die, every single dollar that I put into all of my whole life insurance policies will never leave those policies. It will never stop growing through these dividends, which are around 5 to 6% annually, even when I'm using the money for other things. So I take the money out, I pay off debt. I take the money, I buy real estate. I take the money out, I put it into a new business. I take the money out, I do private money lending, whatever. I buy more gold and silver. That money remains in my policy, growing and compounding at all times. Okay. Now, it's not just growing through simple interest either. It's growing through what's called compounding interest. And if you don't know about compounding interest, go Google it. Albert Einstein called compounding interest. He said, those who understand it use it, those who don't lose it. And he called compounding interest the 8th wonder of the world. It's powerful, powerful stuff. It's that old saying a lot of you guys have heard before. Would you rather have a penny today that compounds every day for the next 30 days? Or would you rather have $1 million today? Well, hopefully you take that penny, because in 30 days from now, that penny is going to be worth $3.4 million, where you would have taken $1 million today. That's the power of compounding interest. So every dollar we put into here, even when we're simultaneously using this, it sits in this policy, compounding and growing uninterrupted, guaranteed for the rest of our lives until the day I die. And if that's not enough for you, this does one more thing for us: tax-free growth. So this money within this policy that's compounding every single year, uninterrupted, guaranteed, is also tax-free growth within that policy. So what did this policy just allow us to do? Well, I mentioned the 3 wealth killers before. Number 1, inflation. Remember, what is inflation? Inflation means the dollar loses value every year. Well, what is the dollars in this policy doing every year? They're guaranteed to grow. And this is guaranteed. When I say guaranteed, guys, as a financial advisor, there is nothing I can tell you is guaranteed growth. Nothing. A fixed annuity, I guess, maybe, Craig. But there's nothing out there. No vehicles, no products, anything that I can say guaranteed. With whole life insurance, it's the only vehicle I can say is a guaranteed growth. Pretty cool, right?
Yeah, and those guarantees are put into the contract, and depending on the company, that could be anywhere from 2% to 3.75%. So that's
Beautiful.
pretty cool. Find a savings account that'll guarantee you a 3% for the rest of your life. So
beautiful thing, man. Beautiful thing. So we're eliminating inflation. What I say about taxes, they erode wealth. Well, if our money's going in here and now it's growing tax-free for the rest of our lives within this policy, do we just eliminate one of the other wealth killers? And then number 3, volatility, of course. What's that magic word we just said? Guarantee. There's no ups and downs. This policy is guaranteed to grow every year, uninterrupted, tax-free for the rest of your lives. And on top of that all, like I mentioned, we can take the money out of here whenever we want. We're in complete control at all times. We can take the money out of here anytime we want for whatever we want. Go to Vegas, put it all on black, double your money. I don't care. Use the money however you want, anytime you want, to do everything else in your life that you're doing anyways. To pay off debt, to live, to go on trips. Shauna, what's a trip you just went on using a policy?
Disneyland, California,
Disneyland.
adventure.
Right?
Hey, David has a question, which I think we should hit on real quick. Is like, what are the downsides of whole life insurance?
Well, Craig could hit this pretty good, but discipline, I would say.
Yeah, consistency.
I mean, at the end of the day, the downsides, and we have this conversation often, is it's a long-term strategy. So you're going to start this. It's going to take some time for it to become efficient, but in the short term, can you do some things to get some immediate benefit without doing whole life? Yeah. But we're all long-term thinkers. We want to build long-term strategies, long-term wealth, long-term control, and have legacy. So if that's no interest to you, then there probably isn't a good fit to do this strategy. But I would say that's really the stumbling block most people have, is they want to see the fruit. They want to plant a seed in the dirt, and they want to have the plant tomorrow. We plant the seed, and it takes some time for the plant to grow. But when it does, like my oldest policy is 15 years old. I wish I had 15 of them. But, so it definitely is a long-term strategy. I guess that's what I'd say the downside is, because we live in an immediate I want instant gratification culture.
Absolutely. And like you said, your policy 15 years, you wish you had 15 of those, because what happens is, because of the nature and how compounding interest works, every year you have this policy, the growth becomes stronger and stronger because it's all compounding within there every single year. So it's really an amazing thing. And, the last thing I want to say on this, Craig, is, once the debts are paid off, once you got plenty of money in here to cover your lifestyle and everything else, well, that's when you start growing wealth. And I mean, how many people do we know that are using policies to invest in the stock market, to invest in real estate deals, private money lending deals, and everything else? So now what we're doing is, not only do we have our money in here growing uninterrupted, tax-free, compounding for the rest of our lives, but that same money at the exact same time is now over here working for us in all these different various types of investments. So now we have growth twice instead of just once. That's why we're called, one reason we're called, the money multiplier. Now, somebody did ask, when you take a loan from this policy, what happens? Well, again, it goes back to control. So you are in complete control over these loans. So when you take a loan from a policy, how and when, or even if you ever pay that loan back, are completely up to you. Now, you always, always, always want to be what we call be an honest banker. So when you take a loan from a policy, you want to treat your money like you would if you were taking a loan from the bank. But here's the difference. If I take the money from my policy and I go buy a new car, okay, and I stop paying myself payments on that car, what's going to happen? Nothing. I'll have to catch up for it later, maybe in the policy, to pay back the loan. But nobody's going to come repo that car. I take a loan from BMW, I stop paying my BMW payment, what's going to happen?
They're coming.
Hook that thing up and take it away, right?
You'll be riding your bike, Stephen.
We have no control.
You're backwards, Mike.
As soon as my money goes in someone else's bank, I give up complete control of that. As soon as my money goes into my bank, I maintain complete control for the rest of my life. Now, you want to be an honest banker. You want to pay yourself back with interest. You want to do everything that Nelson Nash taught. Remember, I said we didn't create or invent any of this stuff. We teach what other very smart people have founded and created. Read this book right here, one of the most powerful books, Becoming Your Own Banker by R. Nelson Nash. If you've read that one, this is another really good one right here as well, with Carlos Lara and Robert Murphy. I'm excited to meet Robert Murphy for the first time in Orlando in a couple weeks. But how privatized banking really works. Another good book, Mapping Out the Millionaire Mystery by Chris and Brent. We can give you that ebook for free, actually. If anybody doesn't have that one, just let us know. We'll shoot you over the digital copy of Mapping Out Your Millionaire Mystery. But just some different resources for you. And you're going to want to follow the principles in there. Don't steal the peas, they say. Be an honest banker. Kind of the rules of being your own banker. But again, but the beautiful thing about it is you're in control, though. So when those what if moments in life happen, those unexpected times happen, it's not going to be financial devastation. It's not going to be foreclosures and repos and everything else, because you are in control as the banker at the end of the day. So, and again, we'll help with all that stuff. So Craig has designed a bunch of really cool tools, the Debt Blaster, to literally show you exactly how to use this entire system to pay off debt, not only faster than without this, but you're also paying off the debt faster while still building wealth. I mean, talk about a win-win, like paying off your debt while still building wealth. It's not either or anymore, it's and. And that's the one thing I want to ingrain in you guys. With this policy, it's not, let me do this or this, or this or this, or real estate or this. It's this and all of this. And as soon as you get that to click, this and all of this, you're going to never turn around and look back at doing things the other way. So with that being said, there's obviously a lot more I could get into with all this stuff with you guys. We could start talking about how do we become the bank and control our retirement dollars? Because again, this is going to be non-qualified money going in. So what do we do with those old 401ks, those IRAs? How do we control that? That's a discussion for another time. But right now, today, I want you guys to focus on this infinite banking concept that's called Become Your Own Banker, the specially designed whole life policy, and what it can do for you today. Where are you? Do you need to pay off debt? Do you need to grow wealth? Do you want to preserve wealth? What's your timeline look like? What's your time horizon for making those happen? Let's get on a call with our money mentors. Let's talk through it. Let's create a plan for you. Again, we're not going to charge for any of that. And what I want to do now is have Craig pull up some slides, because he's kind of taken everything I just rambled on and given some really cool case studies on how this works in real life.
You ever feel like you don't have control of your real estate business or your money? That's right. The big banks and the institutions, they're in control, right? I know you've felt that before. Private Money Club puts you back in the driver's seat. As members often tell us, it's a total game changer. Join the community of like-minded lenders and borrowers by going to privatemoneyclub.com and sign up.
So we're going to run through some use cases of all the stuff Stephen just talked about, show you some of the details of how it works. Okay, so the title of this use case is really thinking about the debt in a 401k paradox. And some of this comes from, we talk to hundreds of people, a month and with our team. And so we learn a lot of things that are going on in people's minds, the things they're struggling with. And this is a common theme. So we wanted to kind of talk about, what can you do if you have lots of debt, you're filling up your 401k, what are some ideas? And of course, these are all ideas. If you want to dig into your specific situation, this is where a call would really be meaningful, because this is going to be more of generic. But what we want to do is talk about, we're going to meet this guy named Dr. Billfold. And in the name comes from some things that Stephen looked up. We're kind of making up a fictitious name, but we have Dr. Billfold here. He's age 45. He's an orthopedic surgeon, so he's making a high wage, and let's say around $409,000 a year. But he's got $300-some thousand of debt. He's struggling with the monthly cash flow. He's filling up his 401k. And really what Dr. Billfold shared with us is that, hey, I can't take my net worth to the grocery store and buy bread, milk, and eggs. So he's looking for some methodologies of maybe how to restructure his financial situation. How can he still prepare for the future, but maybe get some cash flow going? So this is what this whole use case will be about. So what we're going to do with Dr. Billfold's finances, we're going to go through a surgical process. And this is the same thing we're going to do with you, is we're going to first understand what is it going on in your situation. We're going to diagnose this. Do you have debts? What are you trying to accomplish? A lot of people said they have debts that are on the call today. A lot of folks said they're looking to build cash flow, to replace maybe their W-2 job, to build income for the future. So step one is we really want to diagnose the situation, and then we'll come up with a prescription. Together, we'll talk about options of, what's the treatment plan? What can we do? And then what's really cool about our group is that we do have implementations. We have tools that we can show you how this is going to work, put a plan together, how you're going to pay down your debt, help you implement that. So that's really what we're going to do for Dr. Billfold in this situation. So after our conversation with Dr. Fold, we found that he's living paycheck to paycheck, although he's got a really, really high income. He's maxing out his 401k and getting the match from his company. He's got a burden of high debt balances. And unfortunately, he doesn't have a lot of cash flow, so he doesn't have anything to cover those emergency funds, car breakdown, like Sean is dealing with right now, a bunch of ice on the roof. She's got to have someone come and chip this stuff off. Wasn't in the budget. It's something we've got to come up with. And what little bit of savings he has, he's really storing it in an inefficient tool, which is a very low interest savings account. So those are the things that we've diagnosed with Dr. Fold. And if there's any questions, feel free to put those into the Q&A while I'm going through this. I'll try to watch some of that. Stephen, Shauna, if you hear something, we can always put a quick pause on it as well. All right, so here's the diagnostic profile of the doctor. He started working as a surgeon at age 32, making about $175K. So for 13 years, because he's now 45, for 13 years, he maxed out his 401k. And we came up with, he put about $292,000 into that system. That's not what his 401k is worth. That's just what he's contributed in course over that time. He has about $300K of debt. He's paying about $4,665 a month in payments. He has no liquid savings. He has no emergency funds. if the best opportunity in the world came up, he wouldn't be able to take advantage of it. But when you look at his monthly pay, it's 21 grand. He's making a pretty good chunk of change. Unfortunately, he had a failed marriage, so alimony payments of 8,700. Between his rent, his living expenses, at the end of the month, he's got about 681 bucks left over. Now, how many people here have budgets? And when you have a budget that shows how much you have left over at the end of the month, how many times does that really happen? And it's probably not all that often, because the expenses come up, you might go on trips, different things happen throughout the month. So rarely do we have the 681 left at the end of the month. Yeah, so just kind of curious if anyone has that situation as well, if you put it in the chat.
Want to know something funny, Craig? Is I was religious. This is somebody who's been here. I've worked here for however many years. I was really strict about budget and tracking. And then I thought that I was, too cool for school. And for 2024, I didn't really do what I did in 2023 and 2022. And I realized that I don't know, but things went awry for me in 2024. And that's really just by, I guess, not having the discipline that we talked about earlier and not really paying attention to it. So I'll be getting back on the bandwagon this year.
Well, and that's good. And Shauna, one of the things that just reminded me, we were talking earlier about this, and although we're talking about a high net worth, someone's got, or I should say high income earner, making 409,000, 300,000 in debt. Your situation might be different. You might be making 75,000 a year and maybe you have 30,000 of debt or 25,000 of debt. So don't get so caught up in these numbers. We're just simply doing this use case because it's in line with some of the folks we've talked to in the past. But we also talk with people that have a different situation where income's lower and still have, or a higher ratio of debt, to income ratios. So this can happen. This can work for anybody. So just don't be too concerned about the specific numbers. Focus more on the process as we go through this. So some of the things that we talked about with Dr. Fold is the first thing we have to do is change the mindset of how money works, because we're not taught how money works in school. We're not taught about what to do with money. A lot of us, we just go through life, and I did this for quite a while as well when I was back doing my W-2 job, is you just fund the 401k, you go to work, you think you're taken care of for the future. We don't really think about, the money, and we don't know of these other strategies. So we have to change our mindset. We have to watch these videos. We have to do these different things to understand how money really works. And Stephen talked about this a lot, is that if you have debt, one of the best things you can do right now is get rid of it, because we're going into some rough economic times. I mean, inflation's been high, eggs are high, toilet paper costs a lot of money, milk, strawberries, everything costs a lot of money. So if we can get rid of the debt, that's going to really set us up for when there's some opportunities to take advantage of. And some of the things that we want to do for this particular guys are rebalance some of the strategies. Where's the cash going? Stephen talked about some of it goes to savings, some of it goes to bills, some of it goes to investments, whether that's 401k. So is there a way we can rebalance everything so that we can get some cash flow, we can build some retirement, we can build some wealth over time, and build up some savings, emergency and opportunity funds, and put those savings in an efficient place? So that's really what we're looking to do with this particular situation. So what are we going to do? How are we going to implement this? For all of you here, congratulations. I mean, whether you have been in our community for a long time or you're new to it and you want to plug into ours, we'd love to have you. Our campfire is strong. We do a lot of training, but if you're going through this and you listen, like, hey, this isn't the group for me, then find somewhere that can teach you these strategies. And when you plug in, make sure you're asking questions and you're taking action, because at the end of the day, all the stuff we talk about, if you're not taking action, it's not going to really help you. So number one is get a community, get with some like-minded people, find a place where you can store your money. With this use case, we talked about reducing the 401k to the company match, because we want to free up some money so they can do some other things with debt elimination and wealth building. We're going to get rid of these third-party debts, and then after those debts are gone, this is the cool part about it. After those debts are gone and we've recaptured some of that money, we're going to put that to work to build cash flow. And I'm going to show you that model in here in just a minute. So Stephen already shared with you the becoming your own banker. So your prescription, here's your rehab and therapy. you're going to read that book. You may be someone that wants to listen to it. I was just on a strategy call with someone. They said they had a 3-hour drive yesterday and they were listening to the book and thought it was great. So read the book, listen to the book, subscribe to our content. Chris Naugle is constantly putting out things on his YouTube channel. If you can attend any of the live events, we just had one in Sundance, Utah. It was awesome. I know there's a lot of people on the call here that I've seen that were there. It's just really cool to be with like-minded people. We had a thing called the hot seat where people would go into the hot seat, tell us what their challenge, the whole group would constructively give them feedback. So those are other strategies you can do to plug in. So then also with the 401k, we've already talked about reducing some of those contributions. It doesn't have to be forever. We just want to take some of that for the next maybe year or two to do some rewiring of the cash flow so we can get rid of some of these debts. So these are some of the things that we want to do is get rid of the debt, and then talk about investing. Here's the book if you didn't see it before, Becoming Your Own Banker. You can find it on Amazon, Google it, you'll find it. There's lots of places where you can get it. But the one thing that I want everyone to remember is in this process of infinite banking, we have to think about we're either paying interest to someone else on borrowed money to get the things we need and want in life, or we're giving up the ability to earn that interest. And what we're talking about is let's figure out how we can earn the interest and buy the things we need and want. And this book will help bring some clarity to that whole process. Now, as Stephen mentioned, we have some different tools. So whether you're someone in debt, we'll help put a blaster together. We'll map out your debt journey. If you're an investor, we can kind of show you how the investment can flow through the policy. Or maybe you have major purchases, cars, college, vacations. We have different models where we can show you mathematically how this process is going to work specifically for you. So now let's jump into some of the meat. And here's a debt profile. Yours could be, completely different. You might have more credit cards, less credit cards, but essentially this Dr. Fold here, he's got an American Express card with about $15,000 left on his balance. He's paying 21% interest. A Visa card at, almost 16% interest. He also has an office building for his practice, and he's been paying that down over many years. And so he's got $58,000 left on that. Hey, he's got some nice taste for some cars. So he's got a Benz, GLE 53, still owes about $72,000 on that. And then he's been working away at his student loan of $128,000. So net, he's got about $304,000 of debt and paying about $4,665 in debt services a month. So when Stephen asked if you're going to jump on to one of our strategy calls, it's really good if you are in debt to bring this type of information to the call, because we can start to gather that and then start to craft a plan to help you figure out how to get rid of this stuff. So when we look at Dr. Fold's debts, he's got this credit card where he's paying $277. He's got a Visa card, he's paying $382. He's got his Benz, he's paying $407. He's got his clinic, his building that he's paying $720 a month on, and also still paying off his student loans. So how do most people pay off their debts? And what I mean by how do most people pay off their debts is, let's say that I've got this American Express card and I've paid off my $15,842. What do most people do? And put this in the comments. What do most people do with this $277.79 when they're done paying this card? What do they do with that? Brent? Yep, absolutely. Spend it, buy more crap. So what we're talking about is if you continue to pay all these debts off, if Dr. Fold continued to pay off all those debts, like what you're saying in the comments, buy more stuff, spend it, it's going to take him almost 359 months to pay all this debt off. That $304,000 balance is actually going to have about $273,000 of interest. So when Nelson Nash in his Becoming Your Own Banker says, well, you're either going to pay interest to someone or you're going to earn it, who here wants to pay $273,000 of interest to American Express, Visa, the Mercedes-Benz dealer, the building owner, and the college? No thanks. Shane says no thanks. I'm with you on that one. Even though we live in this cold, strange weather, I think our brains are working just fine. So that's how most people pay debts off. Now, let me show you one way you could optimize this. How many people here have heard of the snowball, or have heard of the avalanche, or have heard of cash flow index? Those are different strategies for how to pay down debts. So we have some that do. So the snowball method is really a way of paying down the debts where you order all your debts in the lowest balance first, and then you pay them off lowest balance to highest balance, aggregating those payments. The avalanche focuses on highest interest rate. The cash flow index uses an efficiency score based on your balance and your monthly payments. Now, here's the cool thing. Tim says, yes, but which one is best? That's a great question. And I don't really care if the snowball is the best one or the avalanche is the best one or the cash flow index is the best one. Our tools will figure that out. And in most cases, the avalanche, which is the highest interest rate to lowest, is the most efficient. I've come across some where the cash flow index was neck and neck with the avalanche method, but ultimately we don't really care which one is the most efficient. We want to know which one is. And so in this case, the avalanche is the most efficient. What do I mean by avalanche? Well, if I have $277 going to this Amex card, in 43 months when it's paid off, I'm going to take that $277, and instead of buying more crap or spending it, we're going to add it to this $382, and we're going to add that to our Visa card. So we'll be paying $660 to Visa. In 54 months when that's gone, we'll take the $277 plus the $382, and we'll add it to the $720. So we'll be paying the clinic debt off at about $1381 a month. And we're just going to keep doing that until all the debts are gone. So this is a way more efficient way of doing it. So if you compare this with the first option, which was just keep paying debts off the way we always do it, remember it was about 360 months. Now we're talking about 85. Our total interest, I think, was 273, and now it's 87. So I'm sure many on the webinar today are going to say, I'll do that one. It does take some discipline because you're going to continue using the payments. And so we're not going to be able to go out and spend that or buy more stuff. But look at that, 85 months versus 360 years and an interest of 87,000 versus 270 something. Now watch this. You ever, my kids used to do this all, like, hey, watch this. And then I always knew something crazy was happening. Or someone might say, hold my beer. So hold my beer. If we use the infinite banking method, all we're doing is we're continuing to pay those same monthly debt payments, because you have to keep paying the car payment. You have to keep paying the loans. If you don't pay your car payment, they're coming to get your car. So we're going to continue paying our third-party debts. However, we're going to take our monthly savings, so some of that we pulled out of the 401k or some of the discretionary income, and we're going to start funding a specially designed whole life policy. So we always say they're specially designed, engineered, a dividend-paying whole life policy from a mutual company. So this is kind of a special creature that we help you design, and we're going to fund that. And what we're going to do is that avalanche method, but we're going to take the money out of here while it compounds and grows and add it on top of those third-party debts. So does everybody kind of understand the motion? We're still paying debts, but we're now using our savings to go into the policy and leverage it to help pay off the debts faster. So we're not interrupting the compounding here, but we're accelerating the debt payment. So in order to do that, we need to build a policy. And this is just for some people, you probably don't care, but these are the ingredients. So think of like I'm making a cake, so I'm putting in some flour, some sugar, some, whatever the ingredients are. So in this case, we're putting in $1,500 a month because the Dr. Fold saved some from his 401k, plus he had some discretionary money and he put that all in. He says, I'm going to put $1,500 a month into the premiums. 45-year-old male, standard non-tobacco rating. He's got some chronic illness riders. So these are all the things that we will build into the policy. When you work with us, we'll structure something similar. Now, I'm not going to go into great details, but this is what's called a cash value analysis, which shows us the year-over-year growth, how much we're putting into the policy. So by the end of year one, Dr. Fold would have put in $18,000. He would have had about $13,819 to use. And so really what we're doing is we're funding the policy. We're taking out the maximum loan. We're adding it to the debt. And guess what? It takes about 5 to 6 years for this policy to be cumulatively efficient. Some people will say, well, that's a problem for me. Well, my question is, do you plan on living longer than 6 years? And most people say, yes, I plan on living longer than 6 years. then I say, good, you'll want to do this because now you've got a policy that's just going to continue to be more and more efficient for the rest of your life.
Hey, do you mind
Yep.
if I pop in real quick? The way you just said that, it reminded me of some some of our clients, like specifically Doc Brown is the one that's coming to mind. So this is also a concept and something that you can learn and implement in your life. And if something does happen, there is like a death benefit. So we did have a client who, he really, I'm talking to, Deborah over here in the chat, who is really looking for somebody. And Doc came to one of our events and he truly felt like he found his tribe with us, and he was ready to just begin and begin on this journey. And unfortunately he did fall sick, and but luckily he was about 8 months into this process. And so Carson Hurleen on our team, was able to give a pretty big death benefit check to his sister. And so I do also just want to speak life again into the fact that this is something that you can be learning and applying in your life, whether you know it top to bottom, left to right, doesn't necessarily matter. It's probably one of the only like knowledge things that you can invest in, that if something does happen, it does get passed on in a very positive way in the most horrible of circumstances.
Yeah, I mean, Shauna, that's a really good point, and it's something we don't talk enough about. And the thing is, if like in Doc Brown's situation, if something, God forbid, happens to you, and you have a family you care about, I mean, you may have put in 36,000 within the first 2 years, but your family's picking up, 300 and some $1,000 of coverage just to help them. It doesn't replace you. It doesn't help the pain and the grief, but maybe it can help eliminate some of the stress of the financial burden. So that's a very strong point for this strategy, is that if you have a family you care about, this works really well as that protection. But also, most people say, hey, I plan to live more than 4 or 5 years. So, at that point, I don't care because the policy is going to be efficient. So just know that when we design these policies, we're going to do it specifically how it works best for you. Now, what we did in this case is we put a debt blaster together. I'm not going to go over a lot of the details in this report right now, but I do want to just kind of walk through some of the facts. So remember how we talked about if Dr. Full just continues to pay debts off, pay a debt off and then go spend the money. It takes about 359 months to do so, 273 of interest paid. If Dr. Full just uses the avalanche methodology, we're not talking about infinite banking at all yet, he would be able to save a substantial amount of interest. So for all of you out there, even if you can't do infinite banking, do the avalanche, do the snowball, do something like this, because it's going to help you accelerate and get control of this debt. And so 85 months versus 359, 273 versus 87, I mean, that's a win. However, if we throw infinite banking into the mix, what we're essentially doing is we're taking all those debts and moving them into the policy. So all of those debts, the card, the 2 cards, the car, the student loan, the building, it's all paid off in about 5 years. And then for the next 20 months, we're just going to take that same debt payment and pay the policy back. So in essentially 81 months versus 85 months, your debts are gone, your policy is paid back, and you've effectively only paid 57,000 in interest versus the 273 or the 87. Now, the other question is, how much cash value do I have left in my policy at the end of this? Well, it was this number right here. We've got about 121. So we're going to tell you in that report about how much cash value do you have at the end of that debt cycle. So we'll have about 121,000 that now that our debts are gone, we can build some cash flow. So here we are, let's just say at year 7, we've got about 126. We can use about 121. And then all of this for the next 15 years, I'm just going to, every time I put in 17, 695, I can pull out 22. I put in 17, I can pull out 24. Then we're going to drop down to only putting in 4,700, but I can still pull out 12. So essentially why I'm showing you this is we're going to continue to fund the policy, but we're taking out the maximum loans because we're going to put that money to work to build a retirement income for us. So the use case assumptions that I'm doing here is we have a 5% policy loan rate. I'm not considering taxes. I'm not considering investment fees. So if you were into a stock market fund or something, there could be some fees there. But a lot of us in our community, we do private money club. We loan money out in a first lien position. That's a lot of what I do. Steven does it. Shauna does it. And so in that case, let's just say we're making 12% annual investment return. That's pretty common. If you look in the private money club, there's a lot of 12 to 15% opportunities out there. So essentially what we're going to do is at year 7 of our policy, we're putting in $18,000. Remember, we had about 126,000, but for the model, I'm just going to say we're going to take out $100,000. We're going to put it into what we call a segregated account. I saw some questions earlier. Is there a credit card for the whole life policy? No. We have to take the money out of the policy, put it into a bank account. So a lot of us, what we do is we just have a separate account where the money goes into so we can kind of keep it for tracking. So imagine 100,000 hits your bank account. You find an investment you know, like, and understand. It might be stock market, it might be crypto, it might be real estate. We're not here to tell you what to put it in. But let's just say you put it into a private money club deal at 12%, generates $12,000 a year. Okay, so 12%. Now, one option could be you're going to take the 7,000. So it's going to be about 5,000 in loan interest that we want to pay back to our policy. So we don't want our loan interest to compound on us. So 5,000 goes back to pay policy loan interest. 7,000 is going to go back into reinvest, or at some point in the future, this could be retirement income. So what I'm showing you is just year number 1. Up to this point in the policy's life, you've put in about 126,000. Your net benefit, which is going to be your investment capital plus your cash value left in the policy plus your gains. So you've got about a 6% return and a death benefit of 362. But what I want to show you is what happens when we get to, say, year 10. By year 10, we're only putting in 4729 in the policy. Because of years 8, 9, and 10, we've increased our loan balance. We're now pulling out, even though we're putting in 47, we're pulling out 11. We're adding that to our investment capital. So now you've got 12% of this 198, and let's just say you're making about 23,000 in gains. 8390 is going to pay loan interest. And so now you're rolling in 15,000 back into the investment. Again, at year 10, let's say that's where you want to do your retirement, or you want to start using this 15,000 for retirement income. No problem. Just keep this motion going and living off this 15,000. So now we're cumulatively put in about 166. We have a net benefit of 232, a death benefit of over 200,000, and our cumulative return is pretty close to 40%. So now I'm just going to jump down to year 15 just to kind of give you the wrap up here. We're putting in 47. We're taking out 14,000. Our investment capital is now 370. We've got 11,000 of that going back into loan policy repayment. And now we've got 32,000, essentially of money that maybe at year 15 becomes retirement funds. So now we put in 189 in the system. We had 429,000 of a benefit. We've got a cumulative return of 126. So there's really nothing special going on here other than us putting the money into the policy, pulling it out, investing it at that 12%. Now, we have to remember, where did we start? We started with the fact that we had debt. Dr. Fold had debt. Dr. Fold reduced some of his 401k to increase some cash flow, put that in the policy, paid off his debt. When he's done paying off his debt, we did the investing. Yes.
Was that for the premium deposit? Is that monthly? That for 4,700?
Good question. That's annual.
Okay.
Yep.
Thanks.
Yep. So these are annual numbers, and sorry I didn't clarify that, but yes, these are annual numbers going into the policy. We're pulling out the 14 for that year and then reinvesting. Now, all these numbers could be completely different based on your policy design, your investment, how you want the money to run. But what's really important, and I hope that this makes sense, is just that process. For everyone that said they have debt, there's a path where we can structure a plan to get rid of that debt. Guess what? When the debt's gone, then let's move into building some cash flow and some wealth. And so that's more or less what I wanted to share with you. I know we've gone a little bit over time, but Shauna, were there any questions that we needed to address or any comments?
What company do you recommend for whole life insurance? And please share. And so I think maybe it's a time that we talk about who we are and how we work with insurance companies.
Sure. I mean, it's Stephen, I don't know if you want to take that or you want me to roll with it.
Which one?
And
Yeah, so just kind of the question was, how does our group work? What insurance companies do we work with? And how does all that get put together?
Yeah, great question. And so the way we operate is, we're an agency, we're contracted with several what are called insurance carriers, insurance companies. And so what we're trained to do as money mentors is we'll take your situation, we'll discuss with you, what that looks like financially today, tomorrow, into the future, what your goals are, what problem we're looking to solve, and then we'll create a policy and design a policy with the company that's going to best support, whatever that looks like for you. So just for example, probably the three primary companies we work with right now would be One America, which is also known as America United Life, a company called Lafayette Life Insurance Company, which is owned by the Western and Southern Group. And the third will be a company called Securities Mutual Life, SML of New York. So those would probably be the three primary companies we would go with. They're all mutually owned insurance companies. That's how they pay the dividends. They all strongly support us as infinite banking practitioners, and they fully support, policies being used for infinite banking. There's another company out there called Mass Mutual that we've used in the past. And sometimes you'll hear, people using Mass Mutual for IBC. Mass Mutual is anti infinite banking. And they've actually told agents and brokers that if they're doing infinite banking with their policies, they'll cancel their contract. So if you have somebody talking about Mass Mutual, they either don't know what they're talking about really when it comes to IBC, or they just don't do enough business where Mass Mutual cares. So that's, to me, that's a red flag. Like, you want to work with a company that has lots of options, does tons of business, fully supported in what we do. So that's just some of what we do behind the scenes to kind of make sure you're with the right company. But kind of leave that to us. And we can show you options. We can discuss it with you and explain it to you. But at the end of the day, that's what we do as professionals is be able to take your situation, find the perfect fit, and make sure it's the perfect plan for you to move forward with.
there's a couple more questions too. What if a person is not in the best health? And then additionally, what if you're older, like 65 or older?
Well,
So,
age and health are completely different. So, we insure people in their 70s, quite often, but they're healthy, and then we get people that are in their 30s that are not healthy and not able to get policy. So it really is going to depend on what the health condition is, when it was, that's all stuff that we can talk about. We can, if it's questionable, we can always run it through what's called preliminary underwriting just to check before moving forward with the full application and everything. So again, it's one of those things you got to kind of connect with us on. If you are declined, or if you can't get life insurance, we can talk to you about possibly using like an adult child or a minor child, a spouse, a business partner. There's other little tricks that we can maybe do with friends and things of that nature. So kind of have that discussion. And then, if it's one of those things where, hey, I'm healthy today, but I'm not 100% sure this is right for me quite yet. You might want to, financially or whatever the case is, it's probably still worth a conversation, because something we've been doing lately that's really powerful is we're able to start what's called a term insurance policy on an individual. So a term policy it just means you're buying a certain amount of death benefits for a certain amount of time, usually 10 years. If you die during that time, you get the payout. If you don't die during that time, the policy just goes away and all that money's gone. But what we do is we create what's called a convertible term policy. So what we are able to do that way is start you now with what would make sense. And then regardless of what happens with your health, God forbid something bad, cancer, whatever, like no matter what, that thing is guaranteed to be convertible within that time span. So we can convert that thing later on into a specially designed whole life policy for banking, even if it doesn't make sense today. So there's some things like that we can do that we've just learned over the years through experience. And but at the bottom line, just schedule a call and we kind of talk through that personal stuff with you.
And then if you're somebody on here who has a term policy, and what should they do to just see if it's a convertible term? Do they go back and just kind of ask if whoever their term insurance provider is, say, hey, can this thing possibly be converted to whole life? Is that a step for
Yes.
somebody? Okay.
Yeah, I mean that's the key. They would need to find out, is that policy convertible with that company? And then if it is, we've got some different companies that may take that. For example, Lafayette, One America, they will convert other companies' term insurance policies as long as they're convertible and they meet certain criteria. So the first step would be to find out, is it convertible? And then if it is, reach out to one of our mentors. And I think you put the scheduling link out there. And
Yes.
so then we can have a discussion about what would that look like to convert. Now, I will say this, I think Wendy had asked that question, can you trade a term into whole life? If you can't get insurance because of a health issue, that's a great strategy. But if you still are insurable, I would say it might be more beneficial just to look at starting a new whole life policy if you can get through underwriting, and then maybe just hold on to that term policy for now.
And then I did get a couple questions in the chat about the like where to find a replay, and I do just want to share Chris's YouTube channel once more. I put it in the chat so you can click on it, but if you just go and you find Chris on here, there's all these videos, and then there's something called playlists. And specifically in playlists, you can find, what the heck do we call this thing again? Oh yeah, the Wealth Wednesday webinar Zoom replay. And there's a whole bunch of other ones too. And then you can see, these funny faces that we got here. And another thing is we'll keep doing Q&A right now, but we also do just a Q&A hour from 4:30 to 5:30 Eastern every Wednesday. And so what we're going to try to do, so like right now we got 4 people in here. Stephen, if you can put that link in the chat once more, it'll pull up the one that we're going to have in 105 minutes, apparently. And you can click this little notification bell so that if you're subscribed, and then we'll go through that there. A couple more questions are, my husband is always suspicious and hard to get him on board. How can he be convinced of the infinite banking?
Watch the
Right.
90
Make him a really nice meal, get some popcorn, and watch the 90-minute presentation.
Well, when anyone needs to be convinced, they need to be, that value should be part of it. So what we just kind of covered today of just having liquidity, having access to your money, having control, having a death benefit, that type of thing, I would say start there too.
Well, yeah, I mean, just watch the video, read a book. I mean, if they're not willing to do that, then find someone new. I don't know. But
Dexter said, "Leave them in the dust."
exactly, I like Dusty. Yeah.
And then another question is, at what point would someone start another whole life policy, or do you suggest staying with one? And can you buy a policy for your children?
Yeah. So you'll want to start another policy when you're maxing out your existing policy. And basically what that means is you have more money going into other people's banks than will fit into your banking system. Because when we design a policy, you're going to have a maximum amount that you can put in that thing each year to stay within those IRS regulations that I was talking about at the beginning of this. And so when you get to the point where you're needing to exceed past that limit, you're able to do so and grow your banking system by opening additional policies, and absolutely 100% start policies on minors as soon as possible. My favorite people like Drew on here, he started a policy for his son at 2 weeks, I think it was 2 weeks old. I mean, so definitely get that going. And because these work from compounding interest, the more time, the more powerful they are. My friend Devin Burr, if you guys don't know Devin, go over to Instagram and follow him, Mr._BRRR, Mr. Burr on Instagram. But Devin started a policy for his daughter, and we were looking at it a few weeks ago when we were snowboarding. And that thing, when she's like 60 years old, the thing grows by like 150 grand a year just by itself. Like the growth on it is unfathomable, and it's just because of time, because she's so young. So really powerful, really cool stuff.
I love it. And I put the round robin link in there. So it's mentors.beyourownbanker.com. And that will get you a call with our money mentors to kind of pick up the conversation from here. So definitely let them know you were on the Wealth Wednesday webinar here with us. That'll help them kind of take that conversation further. Frenchie Benjamin, cool name, is saying, if you have $1 million policy and you borrow 100,000 and not pay it back, will the interest in the policy pay back the $100,000 loan?
So depending on the age of the policy, you might be growing enough to the point where it can cover the interest charge. In the first couple of years, no. So it just something you'd have to manage to see where in the life cycle. As the policies get older and older, it's a lot easier to put them on autopilot. But in the first few years, because that efficiency is not there, you're not going to be able to get away with something like that. But we do teach running paying the loans back. As Nelson Nash said, be an honest banker, don't steal the peas, which is an example from his book where you own a grocery store and you walk in the back of the grocery store and take the peas off the back of the shelf and don't pay for them. But yes, to answer that question, it just depends on the age of the policy.
Okay. And then Neela Horton is saying, I am working in New York area right now. My official residence is Arizona. Can I apply as a New York applicant?
You could, but I would highly suggest you use your Arizona
Same.
residence. It just here's the thing with New York, it's almost like it's a separate little country.
I'm in New York, so I'm saying same. So Neela, if I could get a policy in Arizona, which is where Mr. Burr is, I would say do that.
Yeah, it just comes down to there's more options when you're not in New York. There's just some insurance companies that don't want to work with the regulations in New York. So your choices are a little more limited.
Abby is saying, does the death benefit on a policy affect the payment on money borrowed from the policy? And if it does, may the death benefit be higher or lower?
Can you repeat that one more time?
So does the death benefit on a policy affect the payment on money borrowed from the policy? And if it does it make the death benefit higher or lower?
So when you take a loan from a policy, let's say you've got a death benefit of $1 million and you take $100,000 loan, the death benefit, because you're essentially taking an advance of death benefit. So if you take the 100,000 out and you don't pay it back and you pass away or you die, your death benefit's going to be paid out at $1 million minus the 100,000. So 900,000 gets paid out to your family. It doesn't really change the interest calculation, if I understood the first part of that question.
It's in the chat, so let me read it. So does the death benefit on a policy affect payment on money borrowed?
Not
Oh no,
really.
they don't really deal with each other, I don't think.
No, it doesn't. That doesn't have anything to do with the interest cost. So.
All right, and then I'm gonna put the slides. It's a PDF. I'm gonna throw that in the chat right there, so you can grab that.
There was another question. It was something about what's the difference between velocity banking and whole life
Yep, I saw that.
IBC. So, I mean, at the end of the day, velocity banking and infinite banking can work together. And it's something I do. Joe and some others on our team use velocity banking, HELOCs, and infinite banking. So it's a strategy that works well. It just depends on your specific situation. So there's a lot of dependencies there. But sometimes velocity banking can be used to get your debts in a little better shape so that you can do infinite banking. But a lot of those discussions are really best to be handled on a strategy call, just so we can understand your specific situations.
And then I just scrolled up in the chat a little bit. Wendy said, can you open a policy with one large drop payment and not have to make monthly premium deposits?
So that can be handled a couple different ways. One is if you do a large dump into a policy and you don't make any further contributions, that would be a taxable entity. Now, depending on your plans and what you're trying to do, that may be okay, but that's not generally how we design the policies. But that can be done. You can dump a big chunk of money in a policy. It's a single premium whole life policy. Alternatively, we have some designs where you can put a pretty large dump in, and then we minimize the premium down. So that would be a better option to keep it as a non-taxable situation.
And then that just kind of reminded me of what Stephen said about Devin's daughter's policy, though. There is a benefit to wanting to make those payments later in life because it will benefit you later in life. And all those things Stephen talked about in the very beginning of, what did we say? Inflation? All those things, they'll be taken care of if you continue to make these payments. And just some 2 cents of how I set up my policies too. And just, I'm not a licensed agent. I'm a consumer like most of you on this call. I have 3 policies. And in the very beginning, the first one I set up was for the long term because I didn't really understand it, but I knew I would. So I was like, I wasn't too concerned with with getting as much money available to me right up front because I didn't really know what to do with it. So I was like, I'm just going to build a policy that kind of mirrors who I am in this moment, which is I need time to figure this out. Let's get my policy to have time figuring it out as well. So just know who you are and how you're going to roll when you get on those money mentor calls.
Yeah, and the other thing I was going to add to that conversation about the premium pieces, or how long do we have to pay it, or can I not, continue to pay premiums? When these policies get mature and they get into their years 10 and 15 and on, I mean, they're really, really efficient. And so almost think of it this way. If I went over to Steven's house and he gave me $1 and I gave him $4 back, how many times do you think Steven wants me coming over?
Every day.
And so that's kind of what's going on with the policies. We're putting in $1 and we're getting 2, 3, 4, just depends on the time and desire, or the time and the design of the policy. But I plan on filling and I do pay my maximum premiums per year, but if I'm ever on the stretcher going down the hall, I always tell Gina, I'm like, make sure you pay my premiums.
Yeah, big deal paying those premiums for sure.
Yep. So it's a mindset, because you have to move away from thinking about it as a bill. It's not a bill. It's something that I'm putting money into and getting more back. So I'm going to keep doing it. And then I have access to that money within 30 days.
100%. All right, guys, I think that's it as far as questions. I know we have a call in 5 minutes, so we should probably go to the bathroom and get back on.
Any more questions? Join us on YouTube at the Chris Naugle app, Private Money Club at 4:30 Eastern. And I did put a link in there, Sean. I think you announced it, but if you click that link and then hit get notified or notify me, it'll let you know when we go live, which is really cool. And we'll meet you guys at 4:30 for happy hour.
Yes. And then I don't know if you did hit it in the beginning, Steven, too. All of March, if you want to kind of learn various things, all of March, we're going to have like 1 week feed off the other. So definitely come back all of March if you can.
March Money Madness, guys. March Money Madness, 4 weeks of Wednesdays in March. It's going to be a 4-week series. So start with the basics, get into the foundation, and teach some advanced stuff by the end of it. So make sure you have the wealth webinar on your calendars. You're going to want to make all those live in March. And appreciate all you guys being here. Craig?
Thank you. Thanks everyone for showing up, and hopefully we see you on Ask Me Anything at 4:30 Eastern today.
All right, guys, have a great day. We'll see you soon. Thank you. Bye.
All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.